Do you get frustrated during slow, choppy markets? You get whipsawed out of positions, taking loss after loss, when in the end, the market is doing absolutely nothing. In this video, our head of options trading will teach you how to consistently crush it in such a market using a simple option strategy. I'm Mike Bellafiore, and we're one of the top proprietary trading firms in the US with numerous 7 and even 8-figure per year traders. We hope you agree you've found the right place to help grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And if you're like most traders, once earnings season is over, which it basically is at this point, it's often somewhat difficult to find good trading candidates for day or swing trades. So wouldn't it be great if there was an option strategy that worked beautifully in months where you didn't expect much movement? In other words, wouldn't it be great to have a strategy that you could use when you weren't expecting a lot of volatility, and therefore there'd be a kind of a drought of normal day and swing trading opportunities? Well, that is exactly what we're going to be covering in today's video. An option strategy that works best when the market's slow. Now, before we get into the option strategy we're going to be teaching you in today's video, if you're absolutely brand new to options trading, you don't know much about how options work, we put together a video for you to understand options basics. If you click on that video appearing now on your screen, you can watch it. It will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then, when you're finished, you can come back and watch the rest of this video. Okay, so as experienced traders will tell you, there are a few periods of the year where, assuming there isn't anything really major going on, the markets have a tendency to be a little quiet. Over the years, I've noticed that during the summer, or right around the holidays in December, there can be a period of quiet in the market because obviously so many traders are on vacation or taking off time to be with their families around the holidays. And so let's head back to July of this year, in the middle of the month, on July 16th in the summer. And as you can see, for the previous 2 weeks from July 2nd to July 16th, basically the first half of July, the Russell 2000 index, which is the most widely watched index of small cap stocks, have been trading in a tight trading range in the 2200 to 2060 price range all month. And on that particular day, the index closed at 2226.98, pretty much in the middle of that tight trading range. And so suppose that you felt there was a chance that this could be the beginning of a quiet period for the market, as it was now summer, and so you pulled up an options chain expiring a month later on August 15th. And you found that the closest call option to the current price of the RUT index, which is the 2230 call strike price right above where the index closed, and you went ahead and sold 10 of those for a price of 58.60, and then you moved out a month later to September 19th, and you went ahead and bought 10 calls at the same strike price, that same 2230 call, paying 86.10 for those calls. Well, when you do that, selling a call option at a strike price in an earlier month and buying a call option in a later expiring options chain, when you do that, you're entering into what options traders refer to as a call calendar spread, a great trade to make during periods where the market is possibly going to be a little quiet. And so before we analyze how this trade comes out and why, let's first focus on the cash flow ramifications of the trade that we just executed. So we'll start with the calls we bought expiring in September. They cost $86.10, but remember, index options pay off at a rate of $100 per point that the index closes beyond the strike price of the option. So you multiply that price by 100, and you bought 10 of them, so when you multiply it all together, the cost of those calls was $86,100. But remember, you also sold those earlier expiring 2230 calls in August for $58.60, which, as you can see from the same kind of math, results in a credit of $58,600. And so the net cost of the calendar trade was actually the difference of those two, $27.5. And that's what you're going to need to enter this trade in the first place. Let's think about the logic of this trade. Why would you sell an option at a strike price and then buy a later expiring one at the same strike price? I mean, isn't that contradictory? Aren't you going to make money on the long calls, the calls you bought, and lose money on the calls you sold if the market goes up? And conversely, won't you lose money on the calls you bought and make money on the calls you sold if the market goes down? Don't they just cancel each other out and you'd get nowhere? Well, you would think that, except for one thing, and that is that there is a huge difference between the value of an index option expiring in a month and the value of an index option expiring in 2 months, right? Because if you're selling a call option that pays off $100 per point, and the index has 2 whole months to run past that call option and way higher than that possibly, isn't that a much more dangerous option to sell than one that expires 1 month later and only has a month to run? And so of course it is, and therefore you have to charge someone more for a call contract that lasts longer, which gives the market more time to run and create a loss for you if you are the call seller. And so that phenomenon is known as the time premium built into the price of options. And options that expire at the same strike price a month out will always have a higher cost than the ones that expire sooner at that same strike price. So if we sell one that expires earlier and we buy one that expires later at the same strike price, how does that help us make money? Well, let's move to the 4 days before the short calls expired. Let's take a look at August 11th. And as you can see, while the index traded in a bit of a larger range since we started the trade back on July 16th, as you can see, the index ultimately didn't move that much, dropping only 10 points from the price it was trading at on July 16th, closing that day at 2216.51. And so let's take a look at the price of the short call options. We sold those 10 calls at 22.30, expiring just 4 days later on August 15th. And as you can see, those have dropped in value by more than 37 points, which makes sense, right? Because now the index only has 4 days to rally and get beyond the 22.30 strike price. And the index actually did sell off a little bit, so naturally those are going to have a lower price on them than the ones that give the market a full extra month to blow past that strike price. And so the price of the option, which only has a few days left before it expires, is going to drop hugely with only 4 days left. But what about the options we bought? The index went down, right? So the calls should drop, right? The ones we bought should drop. And that's true, but let's take a look at the price they were trading at that day. You see, they only dropped 26 points, down to 60.95. Now, why didn't they drop as fast as the ones we sold? Because they expire much later into the future, 39 days into the future. And so the market has plenty of time to make that call very valuable if there's a big rally. And so the sellers of those calls have to keep the value up substantially. Not as much as required in the middle of July when we first bought them, but still a hell of a lot more than the options that are going to expire in 4 days, wouldn't you think? Okay, so assuming you follow why the prices of the short and long options did what they did, let's take a look at how this trade would come out if we closed it at this point on August 11th. And so the way that you close a calendar spread is to just reverse the original trade, selling the calls you bought and buying the calls you sold. And so as you can see, selling those September calls brought in $69,950 in cash back into our account, but we had to buy back those 22.30 August 15th calls to close out that position at a cost of $21,450. And to determine your profit, you'll obviously have to subtract out your original cost, resulting in $27,500, which is a profit of $12,000 on the trade, which against the original trade cost nets us a return of over 43%. And so what I'd like you to take away from today's video is that the calendar spread is a potentially big winner in a market where the index movement is very mild, as we saw from the middle of July through the middle of August this year, 2025. And the reason for this is that with calendar spreads, as long as the index doesn't move too much in either direction, the major driver of profit is going to be something that doesn't require any effort on your part at all, and that is the simple passage of time. Because the short option of a calendar spread, the ones you sold, will always lose value faster than the long option at the same strike price. So for reasons you can now understand, buying back the short option is always going to be at a significantly lower cost than the proceeds you're going to be getting from selling the ones you bought, resulting in a win as long as the index hasn't moved too much during the course of the trade. And so what I want you to keep in mind about calendar spreads is that all other things being equal or nearly equal, like the price hardly moving in this case, then the relative loss of value in the short options we'll have to eventually buy back to close will always be greater than the loss of value of the calls that we're going to be selling, in other words, the ones we bought originally, because those by definition have a lot longer to go before they expire. And so the sellers of those options are still going to have to charge a lot for those options because the market has much more time to blow up the value of that option, which in turn becomes a losing proposition for the option seller. Professional options traders understand well the relationship between the time value of near-dated options compared to the time value of far-dated options. And under the right circumstances, as you could see, the result of a calendar spread can be terrific.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.